Hi everyone. So this is chapter 1 where we're just breaking out how to compute taxes for the 2019 tax year, being that is the year we're dealing with in the fall of 2019. All the rest of the information on the prior voice lecture is relevant to chapter 1. We just want to make sure that you understand using the most current tax rate schedules, how to compute federal income tax for individuals, using those schedules, and then showing you the way to compute average tax rate, effective tax rate, and marginal tax rate. So in our example, we have Bill and Mercedes. They have $160,000 of taxable income and an additional $10,000 of non-taxable income. You're going to see as we go through the semester, not all the income that a person receives may be taxed. Using the 2019 married filing jointly tax rates. Now, if you're sitting there saying, what's married filing jointly? Don't worry, in chapter 4, we'll be discussing that. But that's one of the options a person who is married has to file their tax return. Now, these tax rate schedules are in the Appendix D in the very back of your book. So there's an Appendix A, B, C, and then D. It's right before the index. So you can refer to that, or in our next slide, we're actually going to have the tax rate schedule so you could see what it looks like. But we're going to not only compute their federal individual income tax, but also their average tax rate, their effective tax rate. And if they received an additional $80,000 of income, taxable income, their marginal tax rate on just that income. So let's see the married filing joint tax rate schedule. And there it is. Now I downloaded this off the internet. So it looks just a tiny bit different than what's in the back of your book, but the picture might be a little bit different color-wise, but the numbers are basically the same. So what this is saying is if you're married filing joint on your tax return, your first $19,400 of taxable income is taxed at 10%. From $19,401 to $78,950, it's taxed at 12%. Now in your book, in the appendix, it says if taxable income is over 0 but not over 19,400. Okay, so the first 19,400 is taxed at 10%, and that's what that's saying. In your book, it says if taxable income is over 19,400 or 19,401, and if you're saying what about the cents, don't worry about it, we always round. Okay, we round to the, using your 50 cents as your normal rounding halfway point, we round up or down, and the IRS is okay with that. Okay, so very similar. So unfortunately, I'm not going to be able to go back and forth between this, but remember something. The taxable income for Bill and Mercedes was $160,000. So when we're computing their taxable income, we're going to find the row that corresponds to their taxable income. So their taxable income is definitely above 19,400. It's definitely above 78,950. So the row that their taxable income falls in is the 78,951 to 168,400. Once you find that row, then you use the formula to the right to compute the tax. So the formula for Bill and Mercedes will be $9,086 plus 22%. Their taxable income is above 78,950. Okay, so let's see how that works out. So taxable income is 160,000 married filing joint. We already said we're going to use the tax formula that is in the row over 78,950 but not over 168,400. And that formula again was $9,086 plus 22% times the difference of their taxable income of $160,000 and $78,950. So the portion of taxable income above $78,950 is taxed at 22%. So when you calculate that amount, add it to $9,086, and their individual federal income tax is $26,917. So that's how you'll utilize the 2019 tax rate schedules. It's exactly the same as the computation in the original PowerPoint. It's just that we were computing it for 2018 instead of 2019. So we don't want to confuse you with that. So we're using the actual rate schedules in the back of your book and computing it accordingly. Now let's complete it. So there it is again. There's their tax due with the formula. But what's their average tax rate? Remember, that's when you take their tax due divided by their taxable income. Remember, not all 160,000 was taxed at 22%, only the part above 78,950. The first 19,400 was taxed very low at 10%. The next, let's say $58,000, $50,000 is taxed at 12%. That next bracket down. And then the amount above 78,950 is being taxed at 22%. So their average tax rate will always be lower because some of their income was taxed at lower percentages. In this case, 16.82%. What's their effective tax rate? What's the tax rate they pay on all of their income, whether it's taxed or not? Well, take your tax and divide it by all income. Remember, they had 10,000 of non-taxable income. So add that in. So for every dollar of income they have, they pay 15.83 cents for tax. Finally, the marginal tax rate, which is always described as what percentage the next dollar of income would be taxed at. In Bill and Mercedes' case, their next dollar of income would be taxed at 22%. So what people will say is, I'm in a 22% bracket. Well, that's just describing what your final destination was. Your last dollar or next dollar of income would be taxed at. And a lot of times people will refer to that as their marginal tax rate. But what if you have a lot more dollars in income, like Bill and Mercedes here? What if they had $80,000 in additional income? What would be the tax rate just on that additional $80,000? Well, how we calculate that is we determine, well, what's the new tax on the new taxable income? If we add 80,000 to 160,000, their new taxable income is $240,000. Calculate the tax on 240,000 of taxable income. You'd have to refer back to that schedule in the back of your book, but they now go down to a different range of income. Now they use the tax formula in the range of income. Taxable income is over 168,400, but under 321,450. The formula in that range of income is 28,765 plus 24% of the amount taxable income, 240,000, is above the 168,400. When you calculate that out, and I didn't put the total there, it will be $45,949. So if you want to jot that down or just make sure you can do that calculation. So how do we find the tax rate just on that additional income? We'll take a look back up where it says marginal tax rate. We take the new tax that we just computed on the new taxable income, the $45,949, and we subtract it from the old tax on the old taxable income. So that difference is the additional tax that has to be paid because of the additional income, or $19,032. Divide that by the amount of additional income, 80,000. So if you take the 19,032 divided by 80,000, the tax rate just on that additional money is 23.79%. And if you think about it, the first $8,400 of that new income is only taxed at 22%. You were in that old range of income using 22%. The amount above 168,400 is being taxed at 24%. So it's very close to 24%, but because some of that additional income is being taxed at 22%, it brings it down a little lower. If all 80,000 fell in the range where it would be taxed at 24%, then our marginal tax rate would have been 24%. Okay, so we just wanted to review those concepts. I know there'll be some practice problems. It's imperative that you understand how to compute federal income tax using the tax rate schedules and how to calculate average tax rate, effective rate, and marginal tax rate. If you have any questions, please post them to the discussion board.